Good evening. It's good to be here with you all. Again, my name is Joel Esquibel. I'm a financial advisor with Edward Jones. I've been in the finance industry for about 13 years now, actually. So I'm always the fun guy at the parties, obviously. I ultimately became a financial advisor because I have a passion for investing and I like helping people meet their financial goals. I think that it's really a great opportunity to change lives, but in order to do that, I need to really truly know my clients and understand their financial goals. So today I'll be sharing some principles of investing that can help you work towards your goals and avoid common investing mistakes. These rules of the road are guidelines that I've learned as a financial advisor. I've worked with clients and watched the financial marketplace. I've seen the value of these principles in achieving success and avoiding problems. So let's go ahead and start with the first rule. Develop your strategy. Successful investing requires deciding what you're trying to achieve and then outlining the steps to get there. It also requires discipline and a little bit of patience. That's why I recommend having a documented, written investment strategy to help provide all of these things. Now, before a financial advisor can discuss investment strategy, they should get to know you and understand what you want to accomplish. That's because your financial strategy should be based on you. There's nothing more important than understanding what's important to you. Only then can you work with a financial advisor to build your personalized strategies and the specific actions needed to achieve those goals. As far as your strategy goes, it should be based on your long-term goals, your length of time to invest, your comfort level with risk, and the steps required for you to get there. You should be specific with your written strategy. The more that you can outline what you're trying to achieve, the more that you can tailor your strategy to your needs. Now, you probably have several long-term investing goals. These might include providing for your retirement, paying for a child's college education, or protecting your family's financial future should the unexpected occur. And that's why we think it's so important to work with a financial advisor to be able to help outline and prioritize your goals. You may need to make some trade-offs along the way. Your strategy can serve as a guide and help you remain on track during market ups and downs. In addition to helping you develop that strategy, a financial advisor can help you maintain discipline and prove guidance to remain focused and to avoid any short-term distractions along the way. Your financial advisor will partner with you and your family throughout your life, revisiting your goals and risk tolerance, as well as the strategies that you've developed to help keep you on track towards your goals. Now that we've discussed strategy, we'll go to our next rule, understanding the risk. So you've likely heard about risk versus reward. Risk and return generally go hand in hand, and the higher the return potential you want, the more risk you're probably going to have to accept. When it comes to investing, it's crucial to understand risk, but not to lose sight of what could be the biggest risk that you face, not reaching your long-term goals. Now, there are several types of investment risks, and we went over them a little bit earlier: economic, inflation, interest rate risk, just a few. However, many investors often think of risk as just the potential for declines. But risk means more than just the potential for fluctuations in value. For example, an all-cash portfolio will have little, if any, change in value over time, but it also won't provide any growth to keep up with inflation. The key is to ensuring that you have the appropriate amount of risk, not too much, but not too little, to achieve your goals. So to determine what makes the most sense for you, you should focus on three main components of risk. What's your comfort level with risk? Understanding this can help you determine how you might react to market ups and downs over time. How much risk are you able to take? The amount of time that you have to invest plays an important role in determining how much risk that you're able to take. And how much risk do you need to take? You'll also want to determine the return and therefore the risk that may be necessary in order to reach those long-term goals. Then you'll work with the financial advisor to build a portfolio that balances your comfort level with the ups and downs of the market, with your financial goals, and the risk necessary to help to achieve them. Another important aspect of this strategy is determining ways to protect against unexpected events that can get you off track. This can help avoid what may be the biggest risk that you face, again, not achieving your long-term goals. The foundation for your portfolio is your asset allocation. The asset allocation is the diversified mix of stocks, bonds, cash, international, or other investments tailored for your situation and designed to support your long-term financial goals. Diversification does not ensure a profit or protect against loss in a declining market, but it can help provide a smoother ride over time by reducing the swings in the portfolio value. So when a single investment or asset class performs poorly, it's a disappointment and not a disaster. And when it comes to diversification, you start with your mix of stocks and bonds. Stock prices tend to fluctuate more over time, but they historically provide higher returns. Bonds tend to fluctuate less, but they typically provide lower returns. So since stock and bond prices often move in opposite directions, combining them may help reduce the swings in your portfolio value. Your mix of stocks and bonds will help determine your portfolio's return potential and how it might react to different market conditions. This is why it needs to align with your goals and comfort with risk. Over time, different stocks may not always behave the same. For example, international stocks don't always move in sync with domestic stocks, or small cap stocks, which are the stocks of smaller companies, can rise and fall at different times from mid and large cap stocks. But what about bonds? The rates on bonds usually move up and down together. However, U.S. corporate bonds and treasuries don't always rise and fall by the same amount or at the same rate as high yield or international bonds. Now, because of this, a broad mix of asset classes can help your portfolio withstand different market conditions over time, better positioning you to achieve those long-term goals. Now, let's go ahead and look at rule number 4. Stick with quality. Of all the factors to consider with investing, we believe that quality is one of the most important, but one of the most overlooked. For some investments, there's an easy way to measure quality, but for most, it does take some work. Since stocks have larger price fluctuations than bond investments, quality is frequently measured by the steadiness of earnings and dividend growth over time, since your total return is the combination of dividends and capital gains. For bonds, one measure of quality is an investment-grade credit rating. This indicates the borrower has a good track record of making the promised interest and principal payments. Quality also means these investments are more likely to overcome temporary challenges, which is why a good track record can be an indication of quality. If you've received any tips on today's hot investments, especially if they've already performed well, the best advice that we can offer is this: ignore them. Although it might be tempting to buy a popular investment, it may not always fit with the rest of your portfolio, and it might be riskier than you expect. If it sounds too good to be true, it probably is. And it might be tempting to look for investments offering the highest dividend or interest rate, but there is no perfect investment. The higher the rate or the yield, the higher the risk most often. Now let's turn from quality to perspective for rule number 5, invest for the long term. Now, who here has heard stories of people making fortunes on 1 or 2 trades? Few people. Well, I can tell you that most successful individual investors make their money over time. We believe the most consistently successful investment strategy is to own a well-diversified portfolio of quality investments and to plan to own these investments for the long term. One of the biggest mistakes investors trying to make is trying to time the market. This might involve moving money into and out of the market in response to short-term declines or the latest prediction. Unfortunately, this usually results into getting in and out of the market at the wrong time, costing you both time and money, and it can result in lower returns over time. Maintaining a long-term perspective can help you ignore the constant noise in the markets and stay invested. We recommend owning a diversified portfolio based on your goals and risk tolerance. This can better prepare you to weather potential short-term issues in the economy and markets. Now, over time, your goals may change, or certain investments may not work out and may need to be replaced, but it's important to make changes for the right reasons, not simply because stocks or other investments may have dropped in price. In general, don't sell quality investments that may have recently underperformed but still play a key role in your asset allocation. Remember, investments don't move up or down at the same time, and that's why diversification can help smooth the ride of the ups and downs of the market. You should keep a long-term perspective and your goals in mind while reviewing the performance of individual investments and your overall portfolio. Now let's stick with the theme of perspective for rule number 6, have realistic expectations. Your expectations about how your investments will perform can have a big effect on your strategy. We believe setting realistic expectations can help you accurately track your progress and ultimately achieve your long-term goals. Now, to set the right expectations, you first need to determine the return that you're trying to achieve, which should be the return that you need to reach your goals. That's why it often doesn't make sense to compare your return to a market index like the S&P 500. An index is not built with your goals and risk tolerance in mind. Your return expectations should be based on your asset allocation, as we discussed in rule number 3, as well as the market environment and your investment time frame. Your financial advisor can help you review your performance in the context of your long-term goals and our expectations for future performance. More importantly, we'll review how that performance affects your progress towards your financial goals. This will help determine whether any changes need to be made to keep you or put you back on track. After you set your expectations, the next step to work on is to help achieve them. To help you achieve these expectations, you should remember the following principles. Don't count on averages. Again, you should focus on the long-term average returns when you're developing your strategy, but remember the markets rarely experience average years. Some years are up, some are down. Short-term declines are just a normal part of investing. And don't chase performance. We've all heard that we shouldn't follow the crowd, but it can be tempting to chase performance. This can lead to buying what's already risen in value and selling investments after they've fallen in value. That's a recipe for underperformance. Now let's jump into rule number 7, maintain your balance. Balance can be an important area in many areas of your life. We strive to balance work with play. We know the importance of a balanced diet. Same can be said about your investments. That's why it's important to work together to review your investment mix on a regular basis. When developing a financial strategy, we focus on your asset allocation. As I've mentioned, this is designed to align with your comfort level with risk and position you to achieve your long-term financial goals. But depending on how your investments perform, your portfolio's allocation can drift from your initial objectives. This means your portfolio may no longer be positioned to accomplish your goals. In other words, you could be taking on too much or potentially too little risk relative to your initial objectives. For example, if stocks outperform for the next several years, you can end up holding more in stocks than you initially intended. When you rebalance, you reallocate your investments to reduce areas where they're overweight and to add to areas where they're underweight. Rebalancing your portfolio regularly can help keep your portfolio aligned with your goals and your comfort with risk and help take the emotions out of your investment decisions. It makes sense, right?
1 second. Asset allocation. What does asset allocation mean?
So asset allocation is going to be, again, jumping back like to rule number 3, where we talked about having a diversified mix of different investments. And so, again, that can mean stocks and bonds, but even within that, there's different types of stocks. And so there's growth stocks, there's value stocks, there's stocks.
Hold on. Asset allocation. Simple terms. If I go to the grocery store and I make tortillas every other day and I buy a big pot of, get a big thing of flour, I need that flour because I make pancakes with it. I make tortillas with it. I make sopapillas with it. Then you need sugar. If I have, at the end of the month, too much sugar, which is only for my baked items, and I make a lot more of tortillas and sopapillas, I need more flour. So then I go back and I reevaluate and say, when I look in my kitchen and say, I have a lot of sugar, but I don't have enough flour for the next month, and I don't have any eggs. That's asset allocation. You're putting all of your stuff in one bucket, is diversifying when you separate it. So I make sure I have garlic salt. I make sure I have onion salt. I make sure I have chili powder. I make sure I have the fundamentals of my kitchen. It's the easiest way that I can think of as asset allocation. So each one of those buckets he's talking about is deciding, do I need more flour? Do I need more sugar? Do I need more eggs? Those are the different buckets of that asset allocation. Back to you.
Thank you, Treasurer. Next slide, please. Rule number 8 is going to be to prepare for the unexpected. Are you caring for young children, getting ready to retire, planning your legacy? At any stage of life, unforeseen events can occur, and they could derail what you're working so hard to achieve. And that's why it's important to be able to adapt to the unexpected, and while you can't predict the future, you can prepare for it. Let's talk a little bit about prioritizing your protection strategies. First is your home, health, and family. Start by protecting your home and means of transportation and having access to health care. This allows you and your family to live your daily life. Strategies could include homeowners or renters insurance, auto insurance, health insurance, and estate documents such as wills and power of attorney. And don't forget about asset titling. Next, you should tackle strategies that protect your income. This can ensure that you can afford your expenses, both expected and unexpected, even in the event of something like a disability or unemployment. Strategies could include an emergency fund, a short-term disability plan, long-term disability insurance, and life insurance. Finally, you should focus on protecting your assets. Because your assets are there to help you fund your goals, you should avoid having to use them to have to pay for emergencies. Strategies could include a long-term care plan, a revocable trust, and umbrella liability insurance. Also, you should keep in mind that the strategies that you need will likely evolve over time as your situation and goals change. It's been a while, and you might want to review your strategies to see if they're still meeting your needs. By preparing for the unexpected and building your strategy to address it, you'll be better positioned to handle the inevitable bumps along the way. Rule number 9 is focus on what you can control. When investing, there are some things that you can't control. For For instance, you can't influence day-to-day market fluctuations, the economy, or the political environment. But the good news is you don't have to. Too often, investors can become distracted by the latest headline or expert prediction. We believe one of the keys to investment success is to ignore these predictions and instead base your decisions on time-tested investment principles. These include diversifying your portfolio, owning quality investments, and maintaining a long-term perspective. What often prevents investors from reaching their goals is not market fluctuations, but their reaction to these fluctuations. They tend to buy when the markets are up and they feel good, and to sell during declines, moving to cash when there's a lot of fear. This is essentially buying high and selling low. It's no surprise, but this is not a successful long-term strategy. The key is to not letting your emotions control your investment decisions. So when an inevitable economic, political, or market-related shock occurs, ask yourself, how does this affect my long-term goals? If your goals haven't changed and the events don't change our long-term outlook, then there probably isn't a reason to make changes to your strategy. In fact, these declines often present good opportunities for long-term investors. We recommend you use these declines to your advantage. And now we'll talk about our 10th and final rule: review your strategy regularly. The one constant thing that you can expect is change. Your goals will change over time, your life will change over time, whether it's a new job in addition to the family, retirement, something unexpected, your strategy will need to adapt. And this is where the review becomes important. Developing your strategy is only the beginning. Your financial advisor will review that strategy with you on a regular basis. Again, your goals can evolve over time, and your strategy may need to adapt, but even if your goals don't change, you'll want to review them in the context of your investment performance to ensure that you're still on track and to rebalance as necessary. During each review, you should work with your financial advisor to help ensure that your portfolio still aligns with your objectives and comfort level with risks, but that's not the only thing that you should address. You'll also want to discuss and review other items, such as your insurance coverage and beneficiaries, to help ensure that these continue to adapt to your needs over time. Now, you may determine that you're on track or decide that you may need to adjust to get back on track, but this is an ongoing process. You don't have to do it alone. Remember, your financial advisor is your long-term partner. By working together to regularly review your strategy and make the adjustments you need, you can have a clear picture of where you stand and what you want to do to reach your goals. So those are the 10 rules. We can go ahead and recap. Again, rule number 1 is going to be to develop your strategy. We recommend having a documented, written investment strategy specifically tailored to your goals. Understanding the risk is rule number 2. Again, the biggest risk that you face when investing may be not reaching your long-term goals. You should understand the trade-off between risk and reward, your comfort level with risk, how much risk you're able to take, and the amount of risk that you need to take to reach your long-term goals. Rule number 3 is to diversify for a solid foundation. Diversification does not ensure a profit or protect against loss in a declining market, but it can help provide a smoother ride over time by reducing the swings in value. Sticking with quality is rule number 4. For stocks, you should focus on the steadiness of earnings and dividend growth over time. For bonds, one measure of quality is a good track record of making the promised principal and interest payments. Rule number 5 is to invest for the long term. Trying to time the markets can be a recipe for disaster. You should maintain a long-term perspective and make changes for the right reasons, not simply based on price fluctuations. Setting realistic expectations is rule number 6. This can help you accurately track your progress and ultimately achieve your long-term goals. Preparing for the unexpected is rule number 8. You can't predict the future, but you can prepare for it. How you address the unexpected will evolve over time as your goals change. Rule number 9 is to focus on what you can control. Now, you can't influence day-to-day market fluctuations, the economy, or the political environment, but you can control how you react. And finally, rule number 10 is to review your strategy regularly. Your goals will change over time, and your strategy may need to adapt. But even if your goals don't change, rebalancing may be necessary to stay on track.